Welcome, everyone. I think this is probably one of our most important webinars, Million Dollar Dream or Money Pit. And there's only one way to find out, and it's actually something that Steve is going to talk to us about today. This is being presented by SCORE Minnesota, and our presenter is Steve Rogers, who is one of our outstanding mentors who, if you don't have a mentor yet, maybe you'd like to ask if he would be your mentor. So let's get started. Click. Just want to tell you a little bit about SCORE Minnesota. We are a nationwide nonprofit organization. We are one chapter in the nationwide organization, and we are a resource partner of Small Business Administration, or your favorite SBA. We provide small businesses with free, and I want to emphasize that we never charge for it, free confidential business mentoring and business education services such as this webinar. Nationally, there are over 300 chapters and over 10,000 volunteers. Our chapter, which I mentioned is the Minnesota chapter, has nearly 90 volunteers ready to help you with your business questions. Our chapter was recently recognized as a District Chapter of the Year. Click. So at what point can we help you? Well, right at the very beginning. That's what Steve is going to talk about. Or in fact, this process should take place as soon as possible. But when can we help you? Pre-startup is really a good idea. Click. Or if you've already started, we can help you open your business. Click. Or as you are in business, if you want to grow your business, we can help you with some strategies that will help you do that. Click. And lastly, if you're thinking about selling or closing a business, or conversely, are you thinking about buying a business? We have a team that will help you make sure that you get the most for your business and pay the least for it, depending upon which side of the coin you're on. Click. We could, if you're interested, if I've enticed you to think about getting a mentor, please think about going to our website, score.org/Minnesota, and just click on the Request a Mentor button. You'll fill in a little bit of information. What are you looking for in a mentor? What help do you need? What is your zip code? And you will receive a SCORE mentor in the next day or two. Click. Lastly, I want to thank all of our sponsors and community partners that make this possible. So thank you to all of these. You'll notice that many of our sponsors are financial institutions. If you go into one of these financial institutions with a SCORE mentor, there's a better chance that they're going to listen to you because they know that an independent, partial person has already helped you work your way through some of the challenges that you might be facing. So without further ado, Steve, I'm going to turn it over to you. So take it away.
Thank you, Diane. Welcome, everyone. So before starting a business, it's important you ask yourself if you can make money. It's quite common that I talk to people that I'm mentoring, asking them this question, and they kind of shrug their shoulders and say, oh, I'm sure I can make money. And unfortunately, they don't. So the easiest way to approach this question is using a financial pro forma forecast. And the word pro forma scares everyone. It is a term that it's important you understand. A pro forma is just Latin for as a matter of form. So it's a format, Latin word for format. And it's a format that banks and investors prefer to see the financial projections you're making for your business. It's a guide as to what your business will look like in the future. And it's based on a spreadsheet tool. So it's the future use of cash. And that's what they care about. And the pro forma lays out the details of what you expect in terms of cash in and cash out. A pro forma is not a financial statement. Financial statements focus on past results. They're put together according to generally accepted accounting principles, usually by a CPA or an accountant. they can, a financial statement can show trends, but they're not your view of what the future will look like. And SCORE can help with spreadsheet skills. This pro forma is usually based on an Excel spreadsheet or something similar. I know spreadsheeting skills are difficult to come by. Diane actually teaches a course on spreadsheet use, so maybe both of us can help you here. So why create a pro forma? Well, if you're going to borrow money or ask for money from investors, they will want to see one. They want to know how much money you need. They want to know what you will do with the money, and they want to know how you will pay them back. All this exists in a well-created pro forma. If you're starting a new business, how much money will you spend before opening the doors? I think a lot of clients tend to forget that there's a lot of money spent before you open the doors for the first revenue. And a pro forma helps you understand how much that will be. Also, how long will you have to last before you start making money? If you've borrowed money from friends and family, they'll want to know when you pay me back, when you pay me back. And it enables you to see in simple terms what products and services make money and what products and services drag you down. You should focus on the money makers and drop the others. If you're buying a business, historical results are in the financial statements. So if you're buying a business, you can look at their tax returns, financial statements for the last several years. But what's the business look like going forward? The person selling the business, do they have a pro forma? Sometimes it might be called a budget, but how does it look going forward? And how will you build on the strengths and eliminate the weaknesses of the business you're buying? And if you already have a business, how can you improve it? Use a pro forma to look at your business model and make more money. But going back to what I said earlier, a pro forma is your view of your business. It's not the investor's view. It's not the lender's view. It's your view. So how do you proceed? If you're starting a new business, first thing you need to look at is what we call the business model canvas. This is something we have presented webinars on in the past. If you sign up for a mentor, they'll introduce you to the business model canvas. It's just a simple plan of what your business is going to look like. It will clarify your thinking on what your business provides and what it needs to succeed. Next, prepare a business plan. We have webinars on business plans. The business plan will solidify your thinking about how you're going to implement what you laid.
Let's go. Unlocking your.
Pardon?
Go ahead. Sorry.
Okay. It will solidify your thinking around solutions to your needs. Third, then prepare a pro forma. The pro forma summarizes everything you've thought about on the business model canvas in the business plan, and it converts it into revenues and costs to answer the question, can I make money? This is what the business model canvas looks like. This is a very simplified version, but it consists of 9 boxes asking you to fill out what it is you're going to do, what is your service, what is your unique sales focus, how will you achieve that, who do you need to help make you achieve that, and then the last 2 boxes at the bottom, how much money is it going to cost you and how much money will you make? Most importantly, as we go through this, to remember, cash is king. A pro forma is all about the cash coming in and the cash going out. If you've got more cash coming in than going out, that's good. In the early days of a business, you will probably see cash going out the door like crazy. And as the business turns around and you grow your business, you grow your products, you grow your customers, then the cash coming in outweighs the cash going out. That's a successful business. But cash is the measure of success. Suppliers, you're going to need suppliers with raw materials or wholesale products that you're going to turn around and retail. Suppliers will rarely extend credit to a new business. You're going to have to live off cash. And by cash, I also mean however much money you can put on your credit cards. Another important thing to remember is that an order and a sale are different events in time. So if you're selling pizzas, the order and sale are almost identical. If you walk into a pizzeria, you place an order, someone places an order, you charge them immediately, and then you make the pizza and it becomes a sale within 15 minutes. If you're a custom shop, you're in home decor or furnishings, for example, it could be months between an order and a sale. If you get an order for drapes for your house, for someone's house, you need to take a deposit at least to cover your raw materials, because the sale doesn't conclude until you deliver the finished items later. So always be aware of the distance between taking an order and actually getting the cash. I repeat, cash is king. You can't run a business if you've got no money in the bank. To repeat what I said earlier, your pro forma is your forecast of expected results when you execute your business plan. It's yours. You put the numbers in. You decide how you're going to address this business. And when you show this pro forma to a lender, an SBA bank, for example, these are the questions they will ask you. And you can't say, Fred told me, or Anne said this. It's you. You're on in the hot seat when it comes to talking to a lender. And they will drill you based on what they see in this spreadsheet. So it has to be built on reality, not on a dream. You have to be conscious of understanding if you're stretching your expectations beyond what's possible. So what does a pro forma look like? This is the summary page of a pro forma. It has several lines down the left-hand side, subject lines that we'll talk about individually as we go through this. I'll tell you what each line represents. And this is the summary page that's broken down into 12 periods. Now, typically these periods would be 1 month. You'd be looking at completing this for a fiscal year, for example. If you've got a very complex business, you might want to do this on a weekly basis. However, that becomes very complex, but it can be done. So behind each line on this sheet, there's a backup worksheet that gives you the answer that goes on this front sheet. And I'll explain that as we go forward. So, first line, cash at the beginning. Here you should enter the total amount of funds you have available. At the beginning of the business, how much cash do you have? Your cash, the total you're willing to put on your credit cards, other people's cash, friends and family. Are they chipping in to help you get started? This does not include at the moment money from a lender, you won't know how much money you need from a lender. And I'm calling that outside money. Outside money means from banks, investors, etc., that expect a return on their money. So let's just start with how much cash you can pull together of your own and your families and friends and credit cards. At the beginning of a business, cash will flow out. Unless you have an amazing business that I would like to invest in, it won't make a return right at the beginning. Later, if you have a successful business, the cash will start to flow back in. That's a positive cash flow. So any good business will go from a negative cash flow to a positive cash flow. And that's the challenge. Can you make your business go from negative to positive? Next line, sales or revenue, as it's sometimes called. So here, this is the most difficult line of all. This is the hardest line to explain to a lender or an investor. Convincing them that you can create the sales revenue to sustain this business, because no sales, no business, right? How will you set your price? Define your product, compare it to the competition, and set a price. Are you going to have a better product that sells for a higher price? Or are you going to have an easier to manufacture and cheaper to produce product that you can sell below your competition? Be ready for that discussion with investors and bankers. How did you set your price? How are you going to compete for market share? Where are the revenues going to come from? And don't just say that I'm going to aim for a 10% market share. The total market's $100 a week, so I'm going to get 10% of that. That argument doesn't work. How are you going to grab that market share at the price you're setting? Include sales of all products and services. So again, behind this summary sheet is a worksheet that details the revenue predictions for every product you have in your portfolio. This can be a complex exercise. Help is available. I've helped other SCORE clients put these pro formas together, so don't get scared. We can help you. What are your assumptions about price changes over time? As we go from period 1 through to period 12, is there a time, is it seasonal? Is there a time when revenues will be higher? Do you sell Christmas ornaments? So in December, do you have a huge revenue, and then in January, no revenue? So be very conscious. Don't just take revenues and spread them out evenly over 12 months. Be realistic about the market and how the market changes, how prices change. Will you have sales? Will you have discount sales? Do you have any historical data to support what you're predicting as seasonal or cyclical revenues? If you make something, can you make enough? Do you have enough equipment to make those revenues? We'll talk about investing in equipment a little bit later. Please don't include sales tax. Sales tax is something you charge the customer and then pass through to the government. So the sales revenue shouldn't include that. And again, this is the hardest line to put together, and it's the hardest line to defend when you're talking to outside investors later. Next line, cost of sales. So these are the costs associated with the products or services you're selling. This line includes something called cost of goods sold, and cost of goods sold I'll talk about in the next slide. But essentially, cost of goods sold means how much did it cost you to make the product, if you're making it. Are there any shipping costs involved? So if you are selling products online, are you including the cost of shipping, or do you pass that through to the customer? That's something you must not forget about, that if you're offering to ship it free of charge, then that cost must be included here. Does it include sales commissions? Do you have a sales force? Do you give them 10% of every dollar of revenue they bring in? If so, that's a cost of sales. If you have spoiled goods, things you make that don't sell. For example, if you're a donut shop and you sell 100 donuts at $1 each, you've got $100 of sales. But if you manufactured 200 and it costs you 50 cents each, then you've lost $100. So always account for lost costs that have not created a sale. They must be accounted for here. And do you need what is commonly called a reserve account? Are you offering a warranty on what you make? If so, how many products are going to be returned under warranty? If only 1% you expect to be returned under warranty, that will cost you to deal with that warranty and replace the product or repair the product. So that's a future cost you should be aware of and accommodate here. Let's go look at cost of goods sold just for a second. So this is where it gets a little bit complex when we're talking about the product you make. Do you, if you have a pizza shop, then you're going to have the pizza maker working all day, no matter how many people walk in the door and order a pizza. If nobody walks in and orders a pizza, you've still got to pay the cook. And that's called fixed labor. It's somebody that's there full time, no matter how many pizzas that person has to make. If you have a product where you only bring labor in to make the product when you get an order, you may have seamstresses that only work when there are items to be sewn. We go back to drapery. So is that seamstress there full time, fixed labor, or is that seamstress there only when there's a product to be made? So if the labor is fixed labor, then the cost of the goods sold is purely the cost of the materials that go into it, because the fixed labor we'll talk about in another category later. If the labor is variable, then the cost of the goods you're selling is the material that goes into the product and the amount of time that labor at an hourly rate was working on that product. I know this sounds a little bit complex, and as I'm reflecting on this, I should have swapped these around and said discuss labor is fixed first at the top of the chart, but the cost of goods sold depends on whether you have got variable labor or fixed labor. And if it's a service business, then the cost of the service is the salary and benefits of the person providing the service, plus any consumed materials. If you're a massage therapist that visits somebody's home, then you charge them for the gasoline to get there, the time of the person, the benefits of the person, and the massage oils they use. So this is cost of goods sold is very important to understand, as is the sales revenue. Once you know these two, you're off to the races. Gross margin. This is often called gross profit margin or just profit margin, but it is not a profit. I usually prefer to not use the term profit here at all. It can confuse people when they see dollars on this line and they think they're making a profit. What gross margin is the difference between the revenue and the cost of sales. So the dollar sales minus the dollar cost of sales equals the dollar margin. It's simply sales minus cost. It's useful to also look at that as a percentage. So you take the dollars margin divided by the dollars sales times 100, and that's the margin in a percentage. The reason it's useful to have the margin in dollars and the margin as a percentage, you'll see later as we go through this exercise. Margins change over time. Competition can drive your prices down. If you introduce a new premium product, you can charge a higher price and your margins go up. Suppliers can impact the costs of your product and your margins will drop. Even the price of gasoline can have a major impact. Every time gas prices go up, the price of raw materials goes up and your cost of sales goes up and your margins go down. This is a dynamic environment. So now you know what the gross margin dollars are. Sales minus cost of sales. That money, those margin dollars now have to fund what we call the operating expenses. And the operating expenses are three categories: general and administrative expenses, sales and marketing expenses, and research and development expenses. Those three categories are called the operating expenses. So you have to have enough margin dollars to fund operating expenses. So let's look at each of those in turn. General and administration expenses. These are people that are not counted in your fixed labor cost of goods sold. I think there may be an error there. These are, yes, these are not the people not counted in cost of goods sold. That's correct. These are management people. These are accounting people in your office, people that manage payables and receivables, cleaning and maintenance people, secretarial, administrative. These are all the people that keep the business running day to day. It's not just their salaries, it's their healthcare and benefits and payroll tax, etc. And most importantly, does this include you? Are you part of the general and admin organization, or are you not going to pay yourself a salary until the business is cash flow positive? Other items in general and admin include rent, utilities, any legal bills, any outside accounting for tax preparation, etc., telephone and broadband, insurance costs, loans on interest and interest payments. Just it says beware of creep here, because if you've put your credit cards in as part of the cash at the beginning, as time goes on, the charges on that credit card will start to rise faster than you expect, and the interest payments will rise as well. They're not fixed, so keep aware of that. Any licenses or certifications or permits you need, fuel costs, property taxes, etc., etc. So these are all the general and admin are all the costs of keeping the business running, keeping the doors open, keeping the lights on. Sales and marketing expenses. This is your sales, service, and marketing staff, if you have a staff. It's your advertising costs, your giveaways. Do you give away little treats to people? Do you give away marketing materials? Do you print marketing materials? Do you go to trade shows? If you go to trade shows, you have to fly, stay in hotels. Do you have a website? What's your monthly cost to maintain your website? Do you pay consultants? Do you buy business reports? Do you subscribe to magazines, industry journals, etc.? Capture all these costs on the sales and marketing line. And again, all of these lines have got a backup sheet with the details on. All you have to put in this line is what the total number is each period. Research and development. Many shopfront type businesses don't have research and development, but if you're running a business that designs, engineers, builds product, and you're doing work on improving a product or creating a new product, and you have designers, engineers, fabricators, modelers, you build anything that's not for sale, you have expensive design tools in software. All those things capture as research and development. That's useful to your accountant because in many instances, and I think this varies state by state, any investment in research and development can have a beneficial tax treatment. So be aware of that. Talk to your accountant and they'll help you. So these three lines added together are your operating expenses. So now we're in a position to calculate operating earnings. So I filled in some lines here just to give you an idea. Let's assume we started with $50,000 of cash to spend. And in this period, we had $10,000 worth of sales and $5,000 worth of cost of sales. So that means we have a gross margin of 5,000. So 10,000 minus 5,000, we've got 5,000 of gross margin. And that's a gross margin of 50%. Then let's assume general and admin expenses cost us 2,000. Sales and marketing cost us 1,000, R&D 1,000. So we had total operating expenses of 4,000. So let's go back up. We had gross margin of 5,000. Out of that 5,000, we spent 4,000 on operating expense. That leaves us operating earnings of $1,000. You could say we're making money, but two things you have to take into account. Did we have any capital spending? Capital spending meaning, did we buy anything major? Did we have to buy equipment for the pizza place? Did we have to buy ovens? And I'll look at that in a second. Plus, inventory. Before you open the doors and start selling, did you have to stock inventory? So let's look at those two items. Capital spending. Capital spending usually refers to major purchases that have a life and can be depreciated over time. But depreciation is something that you don't need to worry about. That is only relevant when you're an up and running business and you have to file financial results. But for us, all I'm worried about is the cash. How much did it cost in cash to buy the pizza ovens? How much did it cost in cash to improve the facilities before you could move in? How much did it cost for furnishings? How much did it cost to keep up with sales as you progress through this program? Do you have to increase your manufacturing capacity? If you're a landscaper, did you have to buy a trailer? Did you have to buy lawnmowers and equipment? Did you have to buy vehicles? If you can possibly do it in the early days of a small business, please rent all this equipment rather than buying it. Laying out cash to buy equipment when you could rent it is a lot easier on the pro forma results as we go forward. Inventory spending. You'll need inventory to sell. Before you open the doors, you've got to stock with product. It's a major expense if you're introducing a new product, especially if you've purchased a business, and often businesses are in trouble, that's why they're sold. You need to look very closely at the inventory of the stock. Quite often it's expired or junk, or there is none. So don't assume, please, when you're buying a business that the inventory is good. And then be very careful about how you manage the inventory. Just-in-time management means that if you buy a lot of inventory and it moves very slowly, then you've tied up a lot of cash that's just sitting there in inventory, wasting the investment you made in it. And overstocking, especially. Try and buy as you need it, if at all possible. Don't buy stock for a rainy day. It might never happen. So now let's go and look at this again. Here, we had operating earnings of $1,000 in the first month, but we spent $5,000 on equipment. We spent $2,000 on inventory. So at the end, we only have $44,000. We had earnings of $1,000, and then we spent $7,000. So we're $6,000 down from the 50 we started at. So this first period, we're cash flow negative. Cash at the beginning, 50,000. Cash at the end, 44,000. So we're cash flow negative. Then we have to repeat this for every period as we go forward. So here's a scenario looking at, say, 6 months. And the numbers I've changed here to point out some reality. We'll start off with the same 50,000. Very likely you won't have any sales, cost of sales, you won't have any margin in month 1, period 1. You'll spend money on general admin because you'll need a staff to get started. But where you really should be spending money on is sales and marketing. If you don't spend money up front on sales and marketing, then when you open the doors, you won't have any customers waiting to come in. So you have to ramp up the energy before you open the doors. So this scenario shows that we've had 0 margin dollars, 7,000 of operating expense. So the operating earnings are $7,000 negative. We've had to spend 10,000 on capital. We've had to spend 3,000 on inventory. Excuse me. So at the end of the first period, we've got $30,000 left out of 50. So you take that 30 to the top of the next column. Excuse me. And that's where you start the second month with $30,000. The end of that month, you've got 15.5 left. But as you can see, as the business moves on to month 5, you've only got 3,300 left, but guess what? In month 6, you went up $500, 3,800. It started to turn positive. So just remember, you don't make money on day one. The sales ramp is always slower than you hope. You can raise the margins with a lot of effort if you focus on it. So general and admin is usually fixed. You don't usually start off with more people than you need and you work them hard. Sales and marketing, early investment is needed to kickstart the business. Capital spending happens early. Inventory has to be replaced or replenished. So you'll notice we bought inventory in month 1 and some inventory in month 2 and then again in month 4. So as you don't forget, you have to put money into inventory. Once you've started, it doesn't refill itself. And be very careful, your interest expenses will start to build up if you don't keep an eye on them. So the next thing is, how long will it take to get back to the 50,000? Now, what often happens is you start with 50, excuse me, that's your money. That's your friends and family. What often happens is that by month 6, you don't have any cash left. And that means that you needed more cash at the beginning. And that's when you should have gone to the lenders. If you filled out this pro forma for a whole year, and you can show that if you had another $20,000 at the beginning and started off with 70, then you could ride it through to cash flow positive before the end of the year, and you'd have money coming in that you could use to pay the lenders back. So the whole exercise here is to be able to convince a lender that you've got a plan that for their investment or loan at the beginning, you can pay them back starting in month 8, 9, or 10, or whatever it is. So this is a very important document to show a banker. So decisions you need to make once you've done this work. If it does make money, is it paying you what you want? Did you put yourself in there as a person in the general admin that's getting paid? If you didn't put yourself in there, then how long are you going to have to last before there's enough money coming in to pay you what you want? Have you been brutally honest with everything that's in there? If you haven't, then a lender will figure that out very quickly. Can you respond to a competitive threat? If you enter this market where others are already in the business selling the same product or service, they will push back on you. You will be a threat to them. Can you withstand that? Keep the pro forma as a living document. Every month that goes by or every period you choose and it goes by, make corrections to show what really happened and correct it to reflect reality. Always remember, hope is not a strategy. And if the pro forma says, no, you can't make money, what can you do? What is the biggest issue? What can you fix? Can you eliminate whatever it is that's draining the cash? And work this with someone else. Get a second opinion you can trust. Don't have to do this in isolation. Try different scenarios. What do you think will happen if you raise prices or drop prices? What if you changed volume of business? If you tried to run a smaller business with less capital investment, less equipment, less people, could it run at a profit with less volume? Can you reduce product costs? Is there anything you can do to eliminate the cost of some of the smaller items in the product cost? Can I eliminate some of the products and just focus on the ones that make money? Would a new product be a better choice than an existing product? And more importantly, when will my cash run out? How do I outlast the competition? Don't sit still. Keep improving the outcome. Keep fine-tuning this. So behind the scenes, as I said earlier, there's a spreadsheet for every one of these lines. In fact, on sales, the sales line and cost of sales, I have a client with 40 different products, and we know the revenue number and the cost of sales number for every individual product. We know the margin on every individual product out of 40 products, all original products. They're not brought in from outside. So this this amount of detail grows over time. And remember, you're not expected to be able to do this yourself immediately. If you've never done this before, it can look very intimidating. But if you can find your score mentor to help you produce this, give you some guidelines on how to complete this, it'll be much easier for you. And once it's finished, you'll be glad you've got it. And one more thing. An old proverb, teachers open the door, but you must enter by yourself. By that, I mean that your mentor will help you as much as possible to construct this pro forma, help you fill in the numbers, but after that, it's yours. You cannot hire the mentor on a daily basis to make small changes. You have to learn how to do this and manage it yourself. And with that, I'll hand back to Diane.
Oh, wonderful. Thank you, Steve. Can you believe there's not one question? I think everybody has been mesmerized by your content and your voice.
I think I've put them to sleep. Yeah.
No, just intent on listening. Yes, so for all of you out there, if you're interested in applying for a mentor, it's free. Go to score.org/Minnesota and just click on the request a mentor button, and you will be assigned a mentor. You'll be so amazed at how fast you'll be assigned a mentor. It's not uncommon that I'm contacting the potential client the next day. So you never know how quickly you can get a mentor. Click, please, Steve.
Oh, hold on. There you go.
Yeah, just thank you all for coming. If you would, you will be getting 2 emails. One is going to have the link to the recording of this wonderful webinar by Steve. It will also have a copy of all of his slides. And then you'll be getting a second email from our national organization. They want to know, what did you think of this webinar? And what can we improve? What other topics are you interested in? So if you could take a moment and fill that in. One of the questions will be on a scale of 1 to 10. What did you think about the webinar? 10 is better than 1. So let's see what we can do to collect some 10s on that. All right. I think we're finished. We got a comment. Very good content, Steve. So I think he is right. Wonderful. Well, thank you very much for sharing your knowledge with us, Steve, and thank you to all of the people who attended. Thank you for coming. I hope that you got a lot out of this presentation. So I hope to see you all at our next webinar. We have 2 coming up in September. Don't forget to sign up. Thank you, Steve.
Thank you, everyone.
Bye-bye.
Thank you. Goodbye.